Hi everyone, welcome back to BH. Today we're going to continue the series on how to value stocks. We had Sashwath brought us an interesting article again which he read about how it is important to really dive and understand how a stock is priced, where the price point comes from, and why you should really pay attention to what you're doing when you are picking a stock. I thought let Sashwath first explain the article, then we can further talk about how and use this methodology when you come to picking your own stock and value investing.
Yeah, so this is an extension of our discussion the day before when we talked about PE multiples and discounted cash flow. But before we get into that, I wanted to briefly have a primer on what the original way of picking stocks were under the Benjamin Graham School of Investing, and that's sort of where value investing even started. So the straightforward way is to sort of go to the balance sheet, look at the assets, value what the company's assets are worth, and figure out what the price is trading for, and see whether the price makes sense for the assets which the company is offering, and the rate at which the assets are increasing maybe is something which you can factor in. So what Benjamin Graham believed in was cigarette butt investing, and that's something we've talked about on this channel before and on the other channels. But to people who need a primer, cigarette butt investing is basically where you take the working capital of your company and you divide it by the amount of shares and you figure out whether it's trading for less than its working capital. What that basically says is if the company was to liquidate today, forget all its fixed assets and its other stuff. What you want to see is whether if you sell the company's liquid assets today, will it pay for your stock price? That is, if it's trading below that, then it's trading at a very cheap price. So then you can go ahead and buy it, and that's the cigarette butt method of investing.
The
intrinsic value. But you can extend that idea further and look at all the other assets, fixed assets. You can discount fixed assets at. You can say, okay, I'm going to only take up land and other assets and not your equipment and stuff. That can also be a method to value. You can basically pick and choose how you want to imbue value into the company.
True.
But then you sort of move away from that and you say, okay, let's look at earnings. And so the problem, let me just quickly recount the problem with this working capital method. Yes, you might find a wonderful company which is trading well below its working capital, which is actually quite rare now because the trick has been so commonly done that your computer will immediately figure out whether the stock is trading below that and 100 guys will put their money into it. So it's sort of rare for you to find those opportunities. If you do, you're very lucky. But the problem with that method of investing is that if a company is loss making, then your working capital diminishes slowly and they build up their debt, which means that the value which you saw before has basically eroded. So your price becomes expensive, which you paid for it over time. And that's one, you need to look out for whether a company is loss making. And number two, there's no reason that the company should ever reach the price, intrinsic value price which you think it should. That is, a lot of companies are permanently trading at deep discounts and you might end up sitting on it for 10 years without it ever meeting the price which you think it should be meeting. And its working capital might be fine and everything might be fine, but the
mood of the market,
it's just permanently out of favor. So that's possible and you're very unlucky if that happens to you. So now we move on from this and now we look at earnings and we look at brand value and we look at the Warren Buffett way of, or the relatively newly minted Warren Buffett way of investing after Charlie Munger came into the picture.
True.
Which is to look at fundamentals, but you don't want to pay dirt cheap prices, you're okay with fair prices. So
true.
You look at your those rules of investing which common stocks that...
The Fisher,
Fisher, yeah. So one way is to look at Fisher's rules of fundamentals. And you can look at promoters' integrity, you can look at brand value, you can look at all those other factors which basically talk about a good quality company. And then you can then check out their price to earnings multiple and see whether it's a company worth your time.
Yes.
And whether the price is right for you. But again, then we had a criticism very recently. Someone said, price multiple analysis bars you from investing in other companies with relatively higher price multiples.
We spoke about that in our AI video.
So coming to that topic, there is a circumventing way around it and we discussed it briefly. It's called discounted cash flow. And this is where the article comes into play. But discounted cash flow is basically a method where you say, I'll take the future. So you take an investment and you figure out what its cash flows are going to be over the next few years. And then you discount the cash flow, because 100 rupees 10 years from now, due to inflation, is not going to be worth the same amount today. So you need to have a certain discount rate where you say that no, 100 rupees worth today is probably going to be worth 116 or 120 or 130 rupees later in a few years. So what you want to be able to do is you want to forecast the cash. So this is how discounted cash flow works. You say, over the next 5 years, I'm going to predict how my company's cash flow is going to change.
Correct.
So its cash flow can increase based on your analysis. And you can set a growth rate for it, and you can say that over the next 2 to 3 years, it will grow at this much, and these will be the numbers. And the next 5 years, it will grow over this much, and this will be the number. You input it in an Excel sheet for sake of convenience, and then you have a discount rate, which is 1 plus, if you divide that amount by 1 plus R, which is the rate of interest, to the power n, which is the number of years. So that's your formula for discounted cash flow. And then you say, okay, I'm going to discount all these cash flows to its present value. Then you sum it up. And then you say, this is my present value of all the amount of money I will receive in the future. And after a point, you've discounted it so much that it's negligible. So you say that's the terminal year. So now you take all your future cash flows, how much that investment is worth to you, according to your estimate. And then you divide it by the share price, and,
right.
The share count. And then you get how much each individual share is worth. So that basically tells you whether the company is above or below where you think its intrinsic value is, in terms of how much it's going to give you in the future. So in this method, you can also take in the assets, and you can divide the assets also by the share count, and that is also something which you can add to the stock price, or you can do it purely based on revenue. But what this basically gives you is a way of circumventing. So a company today might be 35 PE, but we both think that it's going to grow at its revenue is going to grow by 30% year on year.
Correct. So AI companies we're talking.
AI companies. So your AI company is going to make, and it's very possible, and
Yes.
it's not something out of the realm of possibilities. And you think that these AI companies are going to grow by over 40% of revenue each year for the next 5 years, maybe.
Correct.
Then the PE of 35 now might seem dead cheap, because if you cumulatively add up all the present values of your future cash flow, maybe your PE is just 10, or maybe much lower than that. And that's the case for most of these tech companies in the past, which have blown up in size now. Their PEs, if you look at it in terms of their discounted cash flow model, have been quite reasonable, and you've been able to buy them. So what do you have to say about that? Yeah.
This is very true. But the problem in any of this, it's like, analogy would be like in sports. It's trying to predict who will be the next Dhoni, or who will be the next Cristiano Ronaldo, or the Roger Federer. There are so many players, and there are so many skill levels. There are so many things which can go right and wrong in a company. It's very hard to predict. So there's not a short method. That's why you have different methods of assessing a company. And there are no guarantees that this method will get you into a winner. So this is one methodology. It sometimes works, it sometimes doesn't work. But the reason why it works is your calculation and your analysis is correct.
Yes.
So you must do a deep dive in the company. That's what's most important. Most people think doing the Excel sheet, putting the numbers in, putting the percentages in, then you just divide it and there you've reached a number. No, it doesn't work like that. This works on you understanding the sector, understanding the macro and the micro of that sector, then understanding this company, understanding the future of the company, the history of the company, the owners, and all Fisher's rules come into play here. Once you've done all that and you're confident on that, then you can apply this to see, is the price correct? Is it already being predicted by a lot of people in the market? Is it being overbought? Or have people missed it? Is this a rare opportunity for you? Then you can place your bets. But if you randomly take companies and you start saying, okay, let me just put it into this and let me randomly see what it comes, 50 companies will come great, 50 companies will come bad. You will not know if you should be putting any money in it.
Yeah.
You'll be just literally walking around blind, throwing coins in all direction, hoping that something lands on a slot machine which is going to hit you a jackpot.
Yeah.
Which is kind of crazy, which will probably dissuade you from investing altogether.
Yeah.
So this is something to consider. But like I said, analysis is the most important, and that analysis is based on reading. You have to spend a lot of time reading, And if we, like I famously have said this many times in many videos in this channel, if you do not have the patience to read and you don't have the time to do all this, and your main work and your life keeps you away from all this, please, for heaven's sake, don't do this.
Yeah.
Just do index investing and forget about this. But on the flip side, you're like me and Sashwath. This is something which you're really interested in. This is something you really find as a joy. It's like, more than making money, me and Sashwath enjoy looking at company balance sheets. We like analyzing it. We like debating about it. If it's like that for you, then this methodology might be something that is very successful for you.
And another technical point about this method is that it's not incongruent with the Benjamin Graham way of investing, because Benjamin Graham, all he said was you need a margin of safety and there is an underlying value and you have to figure out what that underlying value is. He proposed a method which worked during his time when a lot of the company's value was in commodities and real life tangible goods, but now you have IT companies where asset prices are completely in brand value and intellectual property, so it's very difficult to value them. So that's where revenues and cash flows come into play. And a way for having a margin of safety here is that you can discount it at the weighted average cost of capital, but you can also increase the discount rate. You can say, no, I think there's a huge amount of risk in this company. I want to discount it at 15% instead of 10% or 5%. And you can be very safe and you can play it safe. Sure, that knocks out a lot of the companies from your list. But as he's already said before, you only want to look at 5-6 companies anyway at most.
Yes.
You never want to sort of open up yourself to 20 other avenues and not be able to keep track of each of them and give them the care which you definitely need to. So the idea is that the more you knock out from your list and the more you're able to focus on the really good opportunities, because that's what Warren Buffett also says. You don't have to pitch, you don't have to swing your bat at every pitch.
Correct.
You don't have to swing your baseball bat at every pitch. You need to figure out that 1 or 2 companies or those 2 pitches which come right for where you can score a home run on them and you can make a huge amount of money and swing it. And that's what Warren Buffett has done over the past. If you look at Berkshire's acquisitions, yes, in the past 20 years there have been a lot of them because he has a lot of money. But before that, all of his biggest investments which have made Berkshire what it is today have been just a handful of them. You can count them on the tips of your fingers. So you've had a few Coca-Colas, you've had a few Seas Candies, you've had a few Geicos, and not very many. So the idea here is that you don't have to swing at every ball. And if you're able to narrow down your field of vision to a few companies which you think are definitely in your price range, that is even better. And you can make that happen through discounted cash flow investing.
Correct. So I hope you found this information useful. It is something Sashwath and me have talked about in the past, and it's something that Sashwath uses on a daily basis. It's a tool we thought we'll share with you guys. It's maybe something you might be interested in using in your future endeavors in investing. Anyway, thank you again for joining us today and Be Rich. Hope you liked this video. If you did, please share it with your friends and family whom you think would be interested in this kind of content. Kindly turn on the bell notification so you'll be updated when we come out with new content. Again, thank you again for joining us on Be Rich.
Thank you.
We had a meeting in Singapore. I was very pleased with the results. Indians received me with great love and affection, and I enjoyed my time in Singapore. The meeting was a big success, and I could meet up people from various walks of life. I miss going to Kuala Lumpur, which is very close to Singapore, just 4 hours drive, and I have been asked to come there. So my team decided on the 11th of June, Sunday, we would do an event in Kuala Lumpur. If you would like to meet me in Kuala Lumpur, kindly send a message at the WhatsApp number given below or drop a mail to the mail ID given below. My team would contact you at earliest. Once again, I thank you for your support for Be Rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.